It was one of India's most admired technology companies, with clients across the world. Its name in Sanskrit actually meant truth. Weeks earlier, it had won a global award for good corporate governance. Then its own founder sent a letter that stunned a nation.
Roughly $1 billion of cash on its books simply did not exist. It had been invented, year after year, out of thin air. This is the story of Satyam, India's Enron. A quick note before we begin.
In the late 1980s, India's software industry was just beginning to rise. In 1987, a businessman named Ramalinga Raju founded a company in Hyderabad. He called it Satyam Computer Services. The word Satyam means truth. Over 2 decades, it grew into a giant. It became one of the 4 largest software firms in the country. It served some of the biggest companies in the world. It employed tens of thousands of people across India. It was even listed on the New York Stock Exchange. Raju was celebrated as a star of the new India.
In 2008, Satyam won a prestigious global award for corporate governance.
An award for honesty and good management. To the outside world, Satyam was a model company. Behind the glass towers, something else was growing.
A hole in the accounts that had been widening for years.
To understand the fraud, you have to understand one simple promise. A company's books are supposed to show what is really there. The cash, the customers, the profits. Investors trust those numbers when they buy the shares.
At Satyam, prosecutors say those numbers were a fiction.
To look successful, the company inflated its sales. It created thousands of fake invoices.
Bills for work that was never done, for customers who did not exist.
Each fake invoice added revenue that was never real. That fake revenue turned into fake profit. And the fake profit had to be stored somewhere on the books.
So Satyam claimed it was sitting on huge piles of cash in the bank. Cash that, investigators say, was simply not there.
To hide it, bank statements were allegedly forged.
Interest income was invented on money that did not exist.
And to pad the payroll, investigators allege something stranger still.
Thousands of employees who never actually worked there. So-called ghost workers, whose salaries could be quietly drained away.
Year after year, the gap between the real and the fake kept growing.
Raju would later describe it in his own haunting words. It was like riding a tiger, he wrote, not knowing how to get off without being eaten.
By 2008, the hole was enormous.
Around $1 billion of cash on the books was imaginary.
Raju needed a way to make that fake cash look real, and he found a desperate plan. In December 2008, Satyam announced a surprise deal.
It would spend over $1.5 billion
to buy 2 companies called Maytas.
Maytas is simply Satyam spelled backwards.
These were construction and property firms,
and they were controlled by Raju's own family.
The idea, investigators say, was to plug the hole. Use the fake cash to buy real buildings and real land.
If it worked, the imaginary money would quietly turn into real assets.
But Satyam's investors were furious.
The company was using shareholders' money to buy the founder's family business.
It was a glaring conflict of interest.
In the United States, Satyam's shares crashed on the news. Within hours, the company was forced to abandon the deal. The escape hatch had slammed shut.
And now, the world was watching Satyam very closely. The collapse of the Maytas deal was only the beginning.
Days later, the World Bank delivered a public blow. It barred Satyam from its contracts for 8 years.
It cited serious concerns over the company's conduct. Satyam's independent directors began to resign.
One by one, they walked away from the board.
The share price kept sliding. Questions about the company's accounts grew louder.
Raju was running out of room. The tiger he was riding was about to turn on him.
On the 7th of January 2009, Raju did the unthinkable. He sent a letter to Satyam's board and to the regulators.
In it, he confessed that the accounts had been falsified.
He admitted the balance sheet carried a fictitious fortune.
Around 5,000 crore rupees of cash that did not exist. That was roughly $1 billion of pure invention. Almost the entire cash balance of the company was fake.
Raju insisted he had not taken the money for himself. He said the gap had simply grown too large to hide.
Then he resigned. When the news broke, Satyam's shares went into freefall. In a single day, most of the company's value evaporated. Small investors who had trusted the numbers were wiped out. 2 days later, Raju was arrested.
So were his brother and the company's chief financial officer.
India's most admired tech firm was now a crime scene.
A fraud this large raised an obvious question.
How had no one caught it for so many years?
Every public company's books are checked by outside auditors. Satyam's auditors were the Indian arm of a global firm, Price Waterhouse. Year after year, they had signed off on the accounts,
including the cash that, it turned out, was not there. 2 of the audit partners were arrested.
Regulators on 2 continents launched investigations. In the United States, the market regulator stepped in.
Satyam and its auditors would eventually pay millions to settle American charges. Years later, India's regulator banned the audit firm from listed companies.
The auditors disputed that they had knowingly done wrong. But the message was clear.
The watchdogs meant to protect investors had missed an enormous fraud.
Now the government faced a hard choice. Satyam employed tens of thousands of people.
If it collapsed, all of those jobs could vanish.
And India's reputation as a tech powerhouse was on the line. So the government did something unusual.
It dissolved Satyam's board and appointed respected new directors.
Their mission was to save the company, not bury it. They opened the books and put Satyam up for sale. In April 2009, a transparent auction was held.
The winner was Tech Mahindra, part of a large Indian group.
It bought Satyam for a fraction of its former value. The company was renamed Mahindra Satyam. Against the odds, most of the jobs were saved. Years later, it was fully absorbed into Tech Mahindra.
The Satyam name quietly disappeared from the market.
But the law was not finished with Ramalinga Raju. The case wound through the courts for years. Hundreds of witnesses testified. Thousands of documents were examined.
Finally, in April 2015, the verdict came. Ramalinga Raju, his brother, and 8 others were found guilty. The charges included cheating, forgery, and criminal conspiracy. Each was sentenced to 7 years in prison.
The Raju brothers were also handed heavy fines. The men later secured bail while they appealed the verdict.
But the conviction stood as a landmark in Indian corporate history.
So what did the Satyam scandal really change?
It became a turning point for corporate India.
Rules on independent directors and audits were tightened.
Investors learned, painfully, to question even the most admired names.
Because the most dangerous frauds rarely look like crimes.
They look like success stories, right up until the moment they break. A company called Truth had built an empire on a lie. And the lie grew, quietly, for years, while everyone applauded.
The lesson is as old as accounting itself.
Numbers can be made to say anything until someone finally checks the cash.
On the fraud terrain, we follow the money, and we expose the fraud. If this story gripped you, subscribe and tell us which case we should uncover next.